हाँ बोलो। वो अभी वैसे नहीं दिखता, बस तुम हो ना, रैंक हो गई, क्या चल रहा है? ठीक है, हाँ, चल रहा है ना ऊपर में करीबन। हाँ हाँ।
Hello friends, welcome to Enjoy Financials classes. Today again we are going to discuss about the various component of assets and liability of a company's balance sheet. See, in the beginning itself in part 1 itself I had already said कि we are going to discuss about the basic of the financials, then how to prepare profit and loss and balance sheet, then calculation of various ratio, and the most important how to decode financials. So the entire our sessions I have divided into four parts. So far we are at the first stage only, that the basics of financial, and you can say the how to prepare the profit and loss and balance it. So thereafter, once this chapter are completed, then we will go to the various calculation of various types of ratio. So in the previous classes, I also discussed about what is the how the company balance sheet is being prepared, and what are the various component of assets and liability, that also we are going to discuss. Partly we have already discussed about the current liability, various component of current liability. So today we are going to discuss about the various component of term liability and the various component of the capitals. Okay. So these are the, see, in my Telegram channel, I used to ask so many questions from the users, that how the, if suppose these are the components of the liability sides, so can you arrive at the components of the asset side? So like if I say, see, this is the capital. This is the capital. Capital means what? Capital is the promoter's money. This is the term liability. Term liability means what? The company has raised the funds from its long-term sources. And this is what? This is the current liability, means it has raised the fund from its short-term sources, right? So if you see, if we put together all these three components, then the size of the balance sheet comes to the 47 lakhs. Likewise, this is the right side, it is the fixed assets, and this is the non-current assets. Investment and all this we have classified into non-current asset, and this is called the current assets. So I have asked many a times questions कि suppose the size of the balance is 47 lakhs and the capital and term loan figure is there, so can you arrive at the current liability? So people are not able to answer. If I say कि I am having size of the balance is 47 lakhs and asset side total asset is 47 lakhs, and we are having liability side term loan of 15 lakhs and current liability of 17 lakhs, can you arrive at the capital? People are not able to calculate. So here, see, since beginning I am telling all of you that various component, before dwelling upon the various component of the balance sheet, you must know that the balance sheet liability side there are three main components, that is capital, term liability and current liability. On the asset side there are three main component, that is fixed assets, then non-current assets and the current asset. So if any figure are not available out of these six na, so through the mathematical calculation we can arrive at. Suppose I say कि we are having total liability of 47 lakhs and fixed assets of, how much fixed asset is coming? 23 lakhs. So fixed asset is 23 lakhs plus investment is how much? 2 lakhs. So total asset side figure is there 25 lakhs. So can we arrive at that how much the current assets are there? So yes, very well we can say that the value of the current asset is 22 lakhs. How? That 47 minus 25 is equal to 22. So the people first know if any figure are not there, how to calculate the components of the balance sheet. If asset side, if the out of any component is missing, means non-current asset is missing or fixed asset is missing, or on the liability side if the capital figure is not there or term liability figure is not there or current liability figure is there not there, then how to calculate? So this also we have discussed in the previous slide, but again I want to repeat because these are very basic fundamental thing that one must know. Now coming to the key, how the capital being used, before discussing again on this, very well we have discussed that the capital part. Okay, here unsecured loan also I have treated as a part of the capital, how it is being used. Okay, so if you see here friends, that the current asset should always be sourced from the current liability and the fixed asset always be sourced from the term liability, right? And margins in both the assets should come from the capital, right? So so but if you, so through the how we are calculating that the margin is sufficient in the current asset is through the current ratio. Suppose the current ratio of a company is 25 and the current liability of a company is 20. So if it is the case, so the how much is coming? 1.25 ratio is coming. And suppose company knows that the 1.25, if I submit this proposal to the bank, so bank will not give me the finance. Suppose. So what he will do, and you are requesting that minimum 1.33 current ratio should be there. So how you will finance? So what company will do? How they can very well manipulate and calculate, increase their ratio from 1.25 to 1.33. How they can increase? So that we will discuss FACR also. So if company has made the investment in its associate concern, suppose the company has invested in associate concern, suppose 10 lakh rupees, only 10 lakhs, and these non-current assets, that investment in associate concern, if they are shifting this figure towards the current assets, so what will happen? Your current ratio will improve. So earlier the current ratio was 1.25. So how much was the figure? 25 divided by 20. Now non-current asset means investment in associate concern, they are showing as a part of book debts. They are not showing as a part of non-current assets. So because of that, now the current asset has become 35 and the current liability is still 20. So because of this, if you see the current ratio is now 1.75. So you will feel very happy with this figure. You now the company's current ratio has improved. But friends, let me tell you, this is not the actual current figure. This is what the manipulated information that it has come to you. So that's why if you are a banker, if you are an investor, if you want to know actually whether the right component has been and they are in the current assets or not, what are the right component mentioned in the current liability or not, if you don't know all these things, then there are chances either you will give the wrong finance or you will invest in the wrong company. So and how you will come to know, unless you know that what are the component of the current liability, what are the component of the current assets. See, everyone knows that the plant and machinery always is part of plant and machinery is always part of what, fixed assets, right? But if you see, if you are going to invest or study the balance sheet of a company who himself means who itself is manufacturing the plant and machinery, so in that case, you see, friends, in that case, the plant and machinery for that company is inventory. It is not the fixed asset for that company, right now. So it has become the inventory. So the plant and machinery then it will become for in that case part of the current assets. Likewise, for a house is always called as a part of the fixed assets. But just you imagine the real estate builder. That real estate builder, they are for those builders, it is house is kind of inventory for them. It will be part of the current asset for them because they are not going to keep those assets for a longer period. They will sell, adjust the loan from where it has taken. So, friends, the same assets and the same liability categorized in different buckets according to the nature of that company. If the nature of the company is different, so the the chances are there the same assets will become fixed asset or current assets. The same liability may become current liability, term liability, or even the part of the capital. So that's why we are discussing the various components of the assets and liability. So as I said that the okay, so that is what I wanted to show you here. That non-current assets, if it converted into the current assets, then the current ratio will improve. Though the actually the company's ratio is not that much good, but because of classification from non-current asset to current asset, the current ratio has improved. So in FACR also, that also we will go discuss later. But here I wanted to just give you overview that how because of change in the nature of the assets, the ratio is changing. Okay. So now coming to the various component of the balance sheet that already we have discussed uh, in the last session also about the current liability, that these are the part of the current liability, and we discuss with some example also that how the provision becomes the part of the current liability, how accounts payable, interest payable, these becomes the part of the current liability. So if you want to know more, you can see my previous video. So the current liability or the current assets, to arrive at the current ratio and quick or acid ratio, these two are the more relevant ratio through which you can know that where the what is the liquidity position of that company. So friends, so just here just I want to highlight what is difference between current ratio and what is difference between current ratio and quick ratio or asset ratio. So the current ratio is the entire current assets divided by entire current liability. Current ratio means entire current assets, matlab whatever the current assets are there. But the quick ratio is with the bird, if you can understand that immediately, that should be immediately realizable without wasting. If company wants to get the money now itself, so in that case immediately the company should have that fund available. So in current asset there are two more main components. First is what, inventory, okay, and second is what, book debts, and rest are then cash and other things. Okay, so here friends, in the current liability the main component is sundry creditors and bank borrowing, you can say. The bank borrowing means cash credit and other things, okay, that provision and all this. So current liability, the figure will not change anything, all the entire current liability will be there. But current asset side, what I said, ki immediate liquid in the form of cash means as and when the company need, he should get that money immediately to repay to its current liability. In that case here, na friends, see, through the inventory, if suppose company needs money of 50 lakh rupees, and company in the form of cash, company is having only just 5 lakh rupees. So in that case, company by the sale of inventory, they cannot get immediately 50 lakh rupees. Why? Because inventory, they have to find the buyer and all this, then only, then buyer will also demand some dues, means the goods on credit and all this. So what quick ratio says, that inventory is not that much easily realizable for the company, but the book date is usually realizable, means even though the debtors of the company is not paying, but the company can approach the bank and get it discounted and get the money. So that's why when we are calculating quick ratio and acid ratio, in that case, inventory are reduced from the total current assets. Okay, so what will happen? So current assets minus inventory divided by the current liability. So then it is called the quick ratio. So then how much should be the quick ratio or acid ratio for a ideal company? So mainly there it differs from industry to industry, but however, as someone says that, as you can say that 1.33 current ratio is the ideal for any industry. Likewise, on an average, I am saying, friends, it is not necessary that 1.33 will be ideal. In some cases, even 1.10 will be ideal. Okay, even 1.25 will be ideal. So likewise, in quick ratio also, it is said that one ratio is ideal for any company. So if the quick ratio is 1, so you can say that the company can at least realize immediately all the fund to adjust the entire current liability. Matlab, if the current liability is 100 and current assets minus inventory equal to is 100, so in that case what will happen? Immediately the company will be able to realize 100 and close entire current liability. So the cash crunch or liquidity crunch, for in this case, it will not be there with that company. So friends, up to this, hope that in brief you must have cleared your doubt about the current ratio and quick ratio. If you have still any doubt, then you can raise the question in the chat box also. Okay, so no issue. Treatment of bill discounted and analysis, that already we have discussed, friends, in the previous session. Okay, now coming to the term liability. What is term liability? So see, as per Indian accounting standard, means Indes, if you go, they are not using the word now term liability. They are using the word now current liability and non-current liability. So we will not discuss in this session about the Indes and all this. So here we will discuss about the term liability, which are very much prevalent in the economy, right? So term liability, see, friends, the term liability, how it is different from the current liability. Term liability is the liability which are having for a period of more than 1 year. Okay, so generally if you say the term loan, the period of the term loan, generally the tenor of the term loan is more than 12 months, maybe for 2 years, 3 years, 4 years, 5 years and all this. Then what are the component which comes under the term liability? So there are various components which come under the term liability. Term loan, okay, unsecured loan, subordinate debts, okay, bonds, debentures, deferred tax liability, preference shares, more than 1 year period and less than 12 years. That this figure I have taken from the one of the bank, that how they are treating the preference shares. Okay, so the period means tenor of the preference share is even the more than 12 years. So anyway, one by one we will discuss in details. Deposit from dealers and any non. So these, if you see, friends, the 1, 2, 3, 4, all the 6, these components are part of the term liability. So see, friends, any non-repayment of the term liability may lead to the insolvency for the company. Why it will lead to insolvency? Matlab, whenever the total assets of the company becomes lesser than the total liability, so in that case it is called that company may become bankrupt very soon. Okay, so that's why it leads to insolvency. So here, friends, We are also going to discuss to arrive at the actual position of the term liability, whether company is sound with the term liability or not. So that is called the DE ratio, DSCR ratio, and FSCR ratio. DE ratio means debt equity ratio, debt service. DSCR means debt service coverage ratio, and FSCR means fixed assets coverage ratio. Okay, friends. Okay. So now we will discuss one by one about the components of this term liability. Okay. So the term loan, if you see, friends, the term loan, as I said already, any loan, if suppose the company has taken any loan for short term period matlab, suppose company has taken just for 6 months, it is a loan, but it will not be treated as a term liability. Why it will not be treated as a term liability? Because already this short term liability we have treated as a part of current liability. So and why we are calculating the current ratio and all this? Because we say that the company should have current asset to that extent that it should be able to meet its current liability. If the company is having suppose 100 and the current liability is 120, so in that case, friends, agar suppose the company is having current asset 100 and current liability 120, so what is current liability? That be payable within a period of one year, right now. So if the company is not having that much current assets and it is payable within a period of 12 months, so how it will pay then remaining 20 lakh rupees? Really, na? Correct, na? So that 20 lakh, because of this 20 lakh, then it will be overdue. So in that case, chances are there that company may have liquidity crunch. So that's why current assets and the current liability, current asset always should be over and above the current liability. So in case of the company has taken short-term loan for a period of 6 months, so already to meet this liability, this should be part of the current asset. Means the current asset should have sufficient fund to meet the short-term liability of 6 months. So in that case, so this term loan we will not treat as a part of term liability. That if the company has taken, if I ask the question that company has taken any short-term loan of 6 month period, so in that case it will not be part of the term liability. It will be part of the current liability. Now coming to the unsecured loan. What is unsecured loan, friends? Unsecured loan, see, there are different financial institution and treating in different way about the unsecured loan. Unsecured loan is also called subordinate debt, okay, and this is also called the quasi equity. Quasi equity. Everyone, if someone is telling that quasi equity is more than the net worth of the company, if the subordinated debt is the more than the company's net worth, so in both the cases you should understand that they are talking about nothing but the unsecured loan part. Okay, so then you see why some bank are treating unsecured loan as a part of sub out as a part of capital, and why some bank is, or at many times someone will not treat as a part of capital. Okay, matlab, if the suppose if the, if the suppose, so some are treating and some are not treating. Why some are treating and why some are not treating as a part of capital the unsecured loan? Because see, if I have given the loan to this company and they are saying that this unsecured loan, first let me tell you what is unsecured loan. Unsecured loan means is the amount which the company has taken from his close relative, maybe from his brother. Promoter might have taken loan and advances from his brother, maybe from his sister, from his father, okay, from his mother, and whoever it is, okay, whoever is close relative. So why the unsecured loan? So if the company is giving undertaking that this amount I am not going to withdraw as long as your term loan will last, as long as your term loan will continue, I will not withdraw. So in that case they are giving undertakings, and even their close relative are not ready to, they don't want this money back, okay, because as long as our loan is going to continue. So in that case many financial institutions are treating this unsecured loan as a part of the capital. Okay, because see, if I am going to run a business and I am having only 5 lakh rupees in cash, so I can ask my father also, "Na, can you give me 2 lakh rupees additional?" Okay, so I can ask my mother also. So it is a quasi equity, means it is not full equity, but as long as any liability occurs, and if the promoter is giving you undertaking that I will keep this amount continue into the business, in that case it will be called as a unsecured loan. Okay, so unsecured loan is subordinate debt or quasi equity. One more thing I will tell you, friends, in many bank, how they are treating the means unsecured loan as a part of the net worth or as a part of term liability. Suppose in net worth, in many banks they are saying that the subordinate should debt should not be more than the net worth of the company. So if the company is having net worth of 100 and the same company is showing the net worth of 100 unsecured loan as 120, so in that case, what those financial institution will do, they will divide unsecured loan into two parts. One is what is the limit of net worth, what is total net worth of that company, 100. So what they will do, they will divide the unsecured loan in two parts, 120, then 120. So what they are saying, that it should not go beyond the actual value of the net worth. So that 100 rupees they will shift towards the net worth, and remaining 20 rupees they will shift towards the term liability. Okay, so in the balance sheet, if you are assessing the company, if the that financial institution is just assessing the company, so they will say that the net worth of the company is 200 and the term liability is that 20 lakh rupees will be added towards the entire term liability. So it depends. So if you are working in a bank, then you should know that what guideline of your bank is, how that how the unsecured loan should be treated in your case. So accordingly you should classify this unsecured loan. Okay, hope that unsecured loan classification is clear. uh, I friends, again I request, if you have any doubts so far, you can raise the query in the chat box. Okay, so now I am coming to the bonds. So what is bonds and debenture? See, friends, any company has two choice to raise the funds. To raise the funds, the company has two choice to raise the fund. First is debt and second is equity. Okay, second is equity. So in the debt, company has again another choice. They can raise the debt from bank, okay? Then they can raise the debt from the market. So to raise the fund from the market, the company can raise either through the bond or through the debentures. Okay, and to raise the fund through the equity, either they can raise through the shares. This is also called the common equity, and second is the preference share. Okay, this is called the preference share. Now we will discuss in brief about the what is difference between bond and debentures. Okay, so bond, and when the company find that the bank interest rate, because many times what happen, friends, that the bank rate of interest is higher, like at present if you see that the many banks has raised the interest rate, or secondly if they find the company that the bank is asking so many term and condition to execute before giving the loan, so in that case also company find inconvenient to take the loan from the financial institution. So in that case what he will do, he will issue either bond or debentures in the market and ask the investor to invest in their bond or debentures. But it is, what is difference between bond and debenture? See, whenever bond is fully secured investment. Why fully secured investment? Because whenever the company is floating any bonds, na, against that bond there is some underlying security, underlying some assets. Matlab, suppose I am going for a greenfield project and I want to issue the bonds to the investor just to raise the fund, because I don't want to move to the bank to for a loan. So in that case, what I will do? So against this greenfield project, means greenfield project means now the bond holder will have right to claim on the project. If the company becomes bankrupt, the bondholder will have the first right to liquidate the, if the company is liquidated, the bondholder will have the first right to get the proceeds from that greenfield project. So whenever the bond is issued, always there is some underlying assets available with that that bond. So that's why the bonds are more secured for the investor, but the rate of interest in the bond is lesser. Why? Because it is a secured investment. But in debentures, whenever the company floats, in the debenture there is no such underlying assets. If the company become bankrupt and the company goes into liquidation, so in that case the investor of the debenture does not get any money. So in the priority waterfall mechanism, if they are able to get, they will get. Otherwise, it is totally unsecured in nature. Then how, why we will invest in debentures? So there are so many external rating agency in the market, right? So they give the rating of that either bond or debentures. Okay, so if you find that the debenture is having double A rating, so in that case you can take a chance, because the returns on debenture is higher than the investment in bond or the FD and all this. So the people also prefer to go for investment in debenture, because the returns in, suppose the Reliance is coming out with debentures, so you know that Reliance is not going to become bankrupt. So any renowned company is coming out with the debentures, so investor used to invest, but it is a unsecured, be careful. But for the bond you can go for the investment, but in that case also please study the balance sheet of that company if you want to go for investment in the bonds. So I hope that bonds and debenture is clear. Bonds and debenture means debenture, against the debenture there is no underlying assets. Against the bond there is always some underlying assets. And friends, they are mostly for a longer period, maybe 10 years, 15 years, or even 20 years. Okay, in both the cases. But friends, there are different types of bond and debentures, that is called redeemable, irredeemable, convertible, non-convertible, cumulative, non-cumulative, various types of debentures and bond comes. So why various types of this nature of bonds or debentures comes? Because see, what is, if I say the example of cumulative and non-cumulative. So if you are going for cumulative means interest which the company claim that I will pay you if you invest in my bonds or debentures. So the cumulative means the interest will get accumulated over the period, and at the end of the, on the maturity date, you will get the entire amount including the interest. But non-cumulative means the company may give you the interest yearly, half yearly, quarterly, or monthly. Likewise, convertible or non-convertible debentures of bond. What is convertible and non-convertible means on maturity date, they will convert the debentures into equity after the once on the expiry. But the investor will have choice. They will write in the debentures key or bonds key in the convertible. Investor will have right whether they want money back or they want their investment to be converted in the equity. So there are so many types of bonds and debentures, and these are mostly applicable in case of big corporates. Okay. So now coming to the deferred tax liability. Deferred tax liability we will come after discussion of preference share and deposit from dealers, because it is deferred tax liability and assets are totally different part. Okay. So first, what is preference shares? See friends, as I said in the diagram, you can see in the right side that equity are of two types. That is the common equity, where the you becomes the owner of that company indirectly, and you, whenever the company goes for any decision like a AGM, in the AGM you are voting whether the balance sheet to be approved of this company or not, means whether you are giving your own decision, you have some stake in that company. So common, so you becomes indirectly the owner of that company in, if you are holding the shares of a company. But what is preference here? But in company, if the company is in loss, so in that case you will not get the any dividend. So what is the benefit for the shareholder? If the company's valuation rise, so in that case your shareholdings value also rise, right now. Secondly, as and when the company declare any profit, means it declare any dividend out of the profit it has gained, so you are also getting that part of that profit, right now, in the form of dividend. But in preference share, na friends, though it is called as shares, but the holder means investor does not have right to vote. Company means the investor of the preference share does not have right to vote, right? Secondly, the company gives the fixed dividend. In case of share, company may or may not give the dividend. But if you are holding the preference share, the company will give you the fixed dividend in the means percentage of, they can say that if you purchase the preference share of 100 rupees, I will give you fixed dividend of 5%. So even though the company is in loss, but still the company is obliged to give you that 5% in the form of dividend. The basic difference, as I said, in the shares, the company, you are having right to vote also for any company's decision, but in the preference share, you don't have any right. And if the company goes into liquidation also, na friends, so in that case, preference shareholder will have priority over the common equity shareholder. Matlab, the preference shareholder will get the fund first of the liquidation value. Thereafter, if any leftover amount is there, so in that case, the shareholder will also get the amount. Okay, so that is the preference shareholder. So now coming to the deposit from dealer. What is deposit from dealer, friends? Whether the deposit, matlab people are not that much clear whether the deposit from dealer, what it's state about me, what it says. So friends, just you take the example of any company. Take the example of suppose Patanjali. What Patanjali says, ki if you want to open my outlet in any city, then you have to give 10 lakh rupees as advance asset security deposit to me. So that if you go against the violation of any guidelines of Patanjali, so in that case, I will forfeit this 10 lakh rupees in our account. So now you see the company, that Patanjali company has received 10 lakh rupees from so many dealers. So if suppose they have received from the 10 dealers, so 1 crore rupees the company has received. So see, 1 crore rupees this company has received. So he will use that amount now for maybe for some investment and all this. Because the past trend says that company has not refunded even the 1% to the dealer. Okay, so in that case what will happen, so it is a kind of long term sources available with that company for investment purpose, right? So in that case, deposit from dealer is a kind of source of funds, source of finance for the company, and it should be treated as a part of the term liability. Now you take the example of suppose Maruti dealer. So even in case if you want to take dealership of any company, na, they are not giving just like that the dealership. They are demanding first. They are demanding first the security deposit. So that security deposit always remain for a longer period, because the Maruti dealers, all the dealers or any such dealer of any company, they are not demanding the fund immediately, and the company is enjoying this deposit for a longer period. So that's why it becomes a part of the term liability. Now coming to the deferred tax liability, friends. What is deferred tax liability? So I have seen people are, even the people at top level are not that much clear about the deferred tax liability and deferred tax assets. So I will tell you with some live, that not live means I will discuss with some example that how the deferred tax assets and liability is created. See friends, deferred tax liability and assets always is created because of difference in, because of difference in difference in depreciation, that you must know. Difference in depreciation, ठीक है, under company act and under company act and income tax act. So this, because of difference in depreciation, that there is a that deferred tax asset or deferred tax liability is created. So now I will quote one example. With example, I will try to make you understand. Suppose the company is having investment in plant and machinery of 1 lakh rupees. ठीक है, plant and machinery of 1 lakh rupees. And the company has made sales of suppose rupees 5 lakh rupees. And total expenses, I am not writing separately here raw material, then sales and general, selling general and administrative expenses, other manufacturing, all put together. Company has made total expenses of 4 lakh rupees. So the company is having total profit of 1 lakh rupees. And this 1 lakh rupees is before depreciation. Before depreciation. Okay, this 1 lakh rupees. Now, as per this plant and machinery, as I said, that 1 lakh rupees investment is there. Now, in the 1 lakh, as per Company Act, suppose the depreciation, the Company Act says you provide 20% depreciation. Whereas the IT Act said you provide 25% depreciation. Okay, so now you see that if the company now the company is preparing the balance sheet as per Company Act, so the depreciation on 1 lakh rupees of plant and machinery will be how much, friend? 20,000 rupees, right? So the 20,000 rupees depreciation is there. So the net profit before tax of the company will be how much? 80,000 rupees. This is profit before profit, PBT. Why I am writing all this? Taki if you see later, then also you should be understand. Now, if I understand that 30% tax is there. So if the 30% tax is there, so how much will be coming? The 24,000 that tax the company is supposed to pay. Okay. So now the profit after tax, that PAT of this company will be how much, friends? 56,000 rupees. Right. So the 56,000 rupees profit will be there. So now this is as per Company Act. But company has to pay the income tax as per the IT Act, right? So now I am calculating as per IT Act. Okay? Now the company will report that I have made the sale of to income tax department. I have made the sales of 5 lakh. And out of 5 lakh, I have made the total expenses of 4 lakhs. Okay. Now this is 1 lakh is this 1 lakh profit is before depreciation. Before depreciation. Okay. Now income tax says how much, that you have to make the depreciation at 25%. Okay. So 25 means how much? 25,000 rupees, right? So if the company is making 25,000 rupees as a depreciation, so in that case, if you see profit before tax is how much? Before tax, same profit before tax how much? 75,000. Now company has to pay 30% tax on 75,000. So how much company has to pay? 22,500 rupees tax. So the profit after tax, the companies will be having profit after tax how much? 52,500. Now you see, friends, from here up to this, hope ki everyone has understood. Now as per Company Act, the profit after tax is 52,500 and as per company the profit is 56,000. Now but the tax that the company need to pay is 22,500. The company need to pay the tax 22,500 as per income tax and as per Company Act 24,000. Now the company is preparing the balance sheet. So as you know that whatever the profit is there, they will write here in reserve and surplus. How much they will write? That 56,000 profit, reserve and surplus, and here in cash and bank balance 56,000 rupees it will reflect. Okay. Now suppose the company has not paid entire 24,000 rupees taxes. So what company will write? Provision for tax. Provision for tax how much? They will write provision for tax 24,000 rupees as per Company Act. And here also they will write cash that is lying 24,000 in the company. But friends, this 24,000 it is lying. But how much actual cash the company will pay? The actual company will pay not 24,000. The actual company will pay 22,500 only. to the income tax department. So from this, if the company pays 22,500, so the cash will go only 22,500 to the income tax department. Remaining 1,500, it will still be lying with the company. So here the provision for tax will be divided into two parts. First, provision for tax, ठीक है? Provision for tax, how much? 22,500, and remaining it will 1,500, it will show towards the deferred tax liability. Why deferred tax liability? Because this company has not paid this 1,500, company has not paid. So this will go off, entire provision for tax, it will go up from the balance sheet, and from the cash 22,500 will go up. Only the DTL, deferred tax liability, will be lying in the balance sheet of the company, 1,500, and here also 1,500 will be lying with that company. So the deferred tax liability with the cash, it will match. So this is how, friends, that the deferred tax assets and liability works. I will show you with one live Excel sheet which I have prepared for all of you. Hope it will help you to understand much better. Okay. See here, from the deferred tax liability, this table I have prepared. So this table, what it says? So in the, if you see, the company has made the investment of 1 lakh rupees in the plant and machinery. And every year I am saying that first year, second year, third year, fourth year, fifth year, every year the company is making the actual sales of 5 lakh rupees, and company has equal total expenses of 4 lakh rupees. Why I made fix everything? Because so that you should understand the concept of the deferred tax assets and deferred tax liability. So if you see, friends, the total, the profit before depreciation is 1 lakh rupees that company is making every year. So as per Company Act, the company is making provision for the depreciation of 20,000 rupees every year. So profit before tax, it will be 80,000 rupees. And so every year the company is debiting from the company's balance sheet 24,000 rupees as a tax, 24,000, and profit after tax, it is showing 56,000. So every year the company is having surplus in the form of deferred tax liability 1,500 every year. Why? Because as per the IT Act, they are every year they are paying 1,500 rupees less. Because on the right side, if you see the with the example that 5 lakh rupees the sales the company has made, and out of that 4 lakh rupees that sales the company has expenses has made, and the before depreciation, profit before depreciation is 1 lakh. So 25,000 rupees the depreciation the company is making. So if you see, as per the Company Act, the company has made all 5 years the depreciation, because it is at 20%. So 20 for 5 years, 100%. As per Income Tax Act, company has made the depreciation for 4 years, because in the 4 years it becomes 100%. So if you see, in the last year, the company has made same the 24,000 as per Company Act. But as per IT Act, the company need to pay 30,000 rupees tax. Every year the company was making 22,500 rupees tax, but in the last year company need to make the 30,000 tax. Why? Because the last year the depreciation has become zero for the company as per IT Act. 30,000 tax. So whereas the company has debited one, as per Income Tax Act, the company has debited only 24,000 in the fifth year, whereas as per IT Act, company need to pay the 30,000 rupees. So from where this 6,000 rupees will come? So if you see at the bottom that 1,500, 1,500, 1,500, 1,500. So total 6,000 rupees. Then the deficit in the deferred tax liability means that 6,000 rupees that company saved during the 4 years, now it has become the liability on the fifth year, because the as per IT Act, now the company is demanding the. So if you see, this 1,20,000 rupees company has paid as per Company Act, and 1,20,000 company has paid as per IT Act. So if you see that this is the how the concept of deferred tax liability occurs. For the deferred tax assets, friends, I will discuss later. In the when we will discuss about the as component of assets parts of the balance sheet. Okay. So hope that you have understood. If you are having any doubt are related to the even the deferred tax liability. So you can raise the query in the chat box for further elaboration. Okay. Okay. So now I will continue with the, so friends, D ratio, DSCR ratio and FSCR ratio, this ratio calculation also I am not going to discuss now, because otherwise if since you are not that much, we have not discussed that much about the rest of the components, so chances are there that we will get confused. Okay. But however I will say you what is D ratio. D ratio is also called the leverage ratio. Leverage ratio means if you are going leverage ratio, if you are studying the financial newspaper, if you are studying the any, if you are watching any financial news, so there are many times that financial analysts or in the newspaper they are mentioning that the company is highly leveraged. Highly leveraged means highly leveraged. So highly leveraged means the company has taken more loan than its capacity. Even in the case of now, if you have heard the news recently, the company Adani Group is in fact highly leveraged group. Means they have taken more loan than its capacity. So here you can say, you can understand friends, if you are having capital of, if you are having capital of 10 lakh rupees and you have borrowed matlab outside liability including current liability and term liability, borrowed suppose 30 lakh rupees, so we can say 30 divided by 10 is equal to 3. The leverage ratio of this company or D ratio of this company is 3. So we can say that the company is 3 times leveraged. Okay. So the leverage is as good as the D ratio. So that anyway we are going to discuss in detail after the completion of the means in the subsequent session. DSCR is debt service coverage ratio. This formula is taken when the how the company will pay. See, in case of retail loan, we everyone knows. In the case of retail loan, everyone knows the company, if that individual is having 1 lakh rupees of income, and out of 1 lakh rupees he has to pay EMI of suppose 50,000 rupees. So you know that company is generating, so company, this individual is having 2 times of the capacity to repay this loan. Likewise, in DSCR also, friends, we we discuss about that how much times of their profit the company is having, how much times of the profit the company is having to repay their loan. So anyway, this also we will discuss with case study in the subsequent slide. And FACR is nothing but FACR is nothing but the fixed asset coverage ratio. Fixed assets coverage ratio means that how much fixed asset the company is having, against which how much loan the company has taken to get the fixed asset. So suppose the term loan outstanding, so and the fixed asset, so there also so many things are there to know, so that part we will discuss later, but here in short we can say the suppose the company is having fixed asset of 100 and company has taken loan of 60. So we can very well say that 60, whatever the figure is coming around, it will come around 1.40. So we can say that FACR of this company is 1.40. So if the company would have taken 100 rupees loan, so in 100 rupees loans, in that case, FACR of the company will be 1. In that case, the company does not have margin at all on the fixed asset. So like current ratio, FS in the current ratio, we ensure that how much margin the company is having in the current assets. Likewise, in the FACR ratio, we come to know or we calculate that how much margin the company is having in the fixed assets. So again, I am telling you, we will discuss in the subsequent session in details. Okay, friends. Now coming to the hope that up to this, you people have understood about the various component of the term liability. So now we will discuss about the component of the capital or net worth. That what are the components of the capital or net worth? So here there are paid up capital, ठीक है, reserve and surplus, share premium, share application finalized for allotment, preference share maturing more than 12 years. As I said, friends, that there are so many then capital subsidy. There are that the validity of the preference share maybe even for 15 years or 20 years. So in many banks, or they say that if you still the dues are there beyond the 12 years, so in that case you can treat that preference share as a part of the capital. So our friend, suppose you are giving a loan to a company, and for a period of 10 years, and the company has also issued the preference share to the shareholder, and the shareholders preference share is going to mature after 15 years. So in that case, you very well know that as long as your loan will last, the preference share is not going to become mature, and company does not have any liability also in that preference share. So in that case, you can treat that preference share as a part of the capital also. So again, I am telling you, friends, don't become a ready-made man. Ready-made means man means don't become that. The stock always is called, if any assets are due within 1 year, is always current asset. If the any this term liability will always be treated as a part of term liability. This plant and machinery will always be treated as a part of the fixed asset. No. In the beginning also I said the plant and machinery for the company who is manufacturing the plant and machinery may be current assets in that case. Right now, because for that company who is manufacturing the plant and machinery, it is inventory for them. So that in that case it will be current asset for them. So that's why, friends, if you want to actually classify or understand the component of various assets and liabilities, go into details about the nature of that company, then you trade. Go into details of the each and every component of that company, ki how we should classify. Because of classification changes, your ratio changes, you may invest in wrong company, you may give loan to a wrong company. Now coming to the add up or share capital. See, authorized. See, before I discuss about the paid up capital, so you first you must know what is authorized capital, issue capital, subscribed capital, and paid up capital, and even the share premium. Friends, I used to ask so many questions in our Telegram challenge. As you know that I play quiz also every day. So in that case, whenever I ask the question that which one of is the part of the net worth, authorized capital, issue capital, subscribed capital, or paid up capital. So I have seen the response many times. People are giving the wrong answer that authorized capital is part of the capital, or issued capital, or subscribed capital. It is only the paid up capital which is part of the net worth. So what is difference then between authorized capital, issued, subscribed, and paid up capital? So okay, so see, I will tell you with this. See, whenever a company is floated, a company is created by any promoters. So in that case, they are preparing the memorandum of association and article of association, right? In the memorandum of association, these six clauses must be incorporated. If these six clauses are not there in the memorandum of association, in that case, the registrar of the company will not register this company as a private limited or limited company. Okay. So what are these six clauses? So first one is name clause, means what should be the name of the company. Registered office means where it wants to get the company registered. Okay. Then object clause means what is the purpose of that company, means what purpose means for which activity the company wants to get it registered. Means if the company, means purpose may be like for the manufacturing of the ready-made garment, manufacturing of the pen, take a manufacturing of the electric equipment. So those things will come as a object clause. So suppose, friends, a company is approaching you for a loan, and in the memorandum of association, it is written that company will deal in only the electrical equipment business, and company is approaching you for a textile business. So in that case, you are not supposed to give the finance. Why you are not supposed to give the finance? Because the purpose of the clause, object clause, differs from what he is approaching for a loan. So in that case, friends, first you ask the company to get the memorandum of association amended, then only you should go or proceed for the finance. So that's why it is a violation of their company's object clause. Then what is liability clause? Liability clause means the directors or promoters who are going to be with the company, whether liability of the company will be limited or unlimited. See, friends, in the case of the company, the liability of the borrower means liability of the promoter means shareholder is always limited. But in case of partnership firm and proprietorship firm, na, the liability always remain unlimited. Matlab, if the company is liquidated, just take a raw example of proprietorship or partnership firm. Even if the company becomes bankrupt, company gets closed, liquidated, still you have a right to claim the amount from the promoters or partners of that firm, partnership firm, right now still the liability continues. But in case of private limited, public limited, and all this company, na friends, if the company goes into the liquidation, as long as the company's assets are there, you can liquidate the assets of that company and get it adjusted, means you can adjust the due amount, but you cannot claim the right over the from the shareholder, right now. So the shareholder you cannot claim, means even the directors is having the limited liability unless or until you take the guarantee from them, right? So that's why the liability clause is there. So they are writing in the that it is a limited, what will be the liability of the directors or promoters. Okay, now coming to the capital clause. See friend, this is very much important. That is what I wanted to discuss with you about the capital clause. Capital clause means how much capital the company is planning to raise into the business. Here, friends, company has not raised. Memorandum of association is prepared before the company start its operation, before the company infuse the capital into the business. Means, so the capital clause is where the company is writing that authorized capital. That authorized capital is nothing but the maximum capital that company can raise. Suppose company has written that the in the capital clause have capital clause, you will see in the form of authorized capital. Okay, authorized capital. So the company will write, friends. So if they are saying that in the capital clause that my authorized capital will be 1 CR. So through 1 CR, you can understand that the company can raise maximum amount of 1 CR. Maximum amount of 1 CR only, 1 crore only. Okay, so the authorized capital that they can raise. So initially chances are there that company has been floated with the investment of just only 10 lakh rupees. So that 10 lakh rupees may be by two directors, director A 5 lakh and director B 5 lakhs. That will come in the subscription clause. So that 1 crore rupees means company can raise or infuse into the business of this company up to 1 crore. But initially they have raised only the 10 lakh rupees. So that will come in the subscription clause. So authorized capital in the capital clause, they will write the authorized capital. Okay. So authorized capital. So under the authorized capital, now 10 lakh rupees that promoter has given. And now he wants remaining, and authorized capital is how much? 1 CR. Now the promoter wants out of 1 CR 50 lakh rupees. Okay, 50 lakh rupees to be infloated from the market. To be matlab, to be share to be issued, and they want the fund of 50 lakh rupees from the market by way of IPO. So company cannot raise the fund entire 1 crore rupees from the market. Why? Because already the 10 lakh rupees has been exhausted from the 1 crore limit. So the company can now have the option or room for only 90 lakh rupees. Only 90 lakhs. So 50 lakh rupees the company has planned to raise by way of IPO from the market. So the remaining 40 lakh rupees is having still with the company. Okay, so out of 50 lakh rupees, now they are floating the IPO. Out of 50 lakh rupees, only 40 lakh rupees of subscriber have subscribed this shares. Only 40 lakh rupees have subscribed. So 10 lakh rupees is still unattended. Matlab investor is giving the lukewarm response, very less response in the IPO. So you must have heard in the news also, na, in many times the IPO have been subscribed only 0.4 times, or IPO has been subscribed only half times, matlab 50% of the total IPO. But nowadays, friends, you will see that it is always subscribed 30 times, 40 times, and all this. But I am telling you just to understand that how it happens. So 40 lakhs rupees, see, 1 crore is the authorized capital. Now the 50 lakh rupees is the issued capital. Whatever the company has planned to raise issue, that is called the issued capital. And out of that, the 40 lakh rupees subscribed, so it is called the subscribed capital. Okay. And now company find that no, this out of 40 lakh, earlier the everything was manual. So the company used to receive manual application for subscription and all this. So company find that application is not proper, and only the company can issue only 30 lakh rupees as a share. So this is called the paid up capital. Paid up capital मतलब कि actual money that company is going to receive from the shareholder. So the paid up capital is the actual capital which becomes part of the net worth, which become part of the net worth, that 30 lakh rupees. So if you see authorized capital of 1 CR, so don't get confused that the company has infused 1 crore rupees into the business. If the if you are getting the issued capital of 50 lakh rupees, don't get confused that company is having the actual net worth of 50 lakh rupees. If you get confused with the subscribed capital, don't get confused with the 40 lakh rupees. If you see the figure of 40 lakh, so it is only the paid up capital which the actually the company has issued the shares, and the actual the amount of 30 lakh rupees it has received from the shareholder. So hopefully that authorized capital, issued capital, subscribed capital, and paid up capital, this concept has been cleared. I am showing you now the live one of sample of one of the companies memorandum of association where all the 6 clause. Okay, these are called the subs clause of the company. Okay, but this is the authorized capital. Here they will write the 100 lakh is the authorized capital. See, name of the company, address, object clause, limited liability clause, authorized capital clause, okay, and subscription of the company. So 100 lakhs. So out of this 100 lakhs, 90 lakhs rupees, 10 lakh rupees promoter has invested. 90 lakh rupees a scope is there. Out of 90 lakhs, 50 lakh rupees IPO. Out of IPO, this is called issued capital. Okay. Out of IPO, now 40 lakh rupees subscribed. This is called subscribed capital. Okay. Now out of 40 lakh rupees, only 30 lakh rupees has been actually company has issued the shares. So this is called the paid up capital. Okay. So the actual capital of the company into the business is how much? 30 lakh rupees. Okay, friends. So this is called the paid up capital of the company, and this is part of the net worth. Now, friends, in the memorandum of association, they also have to mention what will be the face value of the shares. What will be the face value of the shares? Suppose the maximum face value can be different also in case of private limited, and unlimited also in case of the maximum face value in case of limited company will be 10 rupees only. So most of the time you will see that 10 rupees is the face value. What is? So if the company is saying that I will raise 100 lakh rupees of share, authorized capital, okay, authorized capital with face value of 10 rupees each. So 100 lakh means, so the 10 rupees each. So it means the company will raise total 10 lakh shares. Then only company can get 1 crore rupees of paid up capital. Right now, 10 lakh into at the rate of rupees 10. So what will happen, friends? Many a times, though the company says the face value of the share is rupees 10, but in the market, the public is ready to buy this company's share, suppose at rupees 100. Company is ready to, means investors are ready to buy the company shares at rupees 100, whereas the face value of the shares of the company is rupees 10 only. So the company, suppose the company has floated, I remove first these all things, then I will discuss. Suppose the company has raised 1 lakh sales, 1 lakh shares, 1 lakh shares at rupees 10. ठीक है. So the company if sells entire shares, the company will receive 10 lakh rupees, right? But if investors are ready to buy each share at 100 rupees, so the company will not get 10 lakh rupees. The company will get actually the 1 crore rupees, means 100 lakh rupees the company will get. Right now, how much company will get? 100 lakh rupees. So how company will account in the balance sheet? When the company is preparing the balance sheet, they will write paid up capital, 10 lakh rupees. Okay. And share premium. Okay. Share premium 90 lakh rupees. So friends, so the total company has got 1 crore rupees. So friends, don't get confused with the share premium word. Share premium is also part of the net worth of the company, because the company has got net worth of the company, paid up capital and share premium. So wherever you get the word share premium, you should understand that the share premium is the company share has been priced at premium, and the investor has paid more money than the face value of the share. So that's why share premium figure is coming. So share premium is also part of the net worth of the company. And so if I ask that what are the component of the net worth, I give you three choice: authorized capital, paid up capital, share premium, and subscribed capital. So in this case, see, authorized capital and subscribed capital will not be part of the net worth. Only the paid up capital and share premium will be the part of the net worth. Okay. So that is what I wanted to tell you. Now coming back to here. Paid up capital, hope you people have understood. Paid up capital is nothing but the equal amount that the company has got from the subscriber, from the shareholder. And these are unauthorized capital, it is just written on the memorandum of association. And issued capital is the when the company is issuing the IPO, that how much actual amount plan company has planned to issue. And the subscribed capital means how much shareholder has actually subscribed. Okay. Now share premium also you must have understood. Share premium means over and above the face value of the share price. Okay. So whatever the company is receiving, that is a part of the share premium. Now coming to the reserve and surplus. Friends, in the reserve and surplus, there are so many words you will come to know: general reserve, revenue reserve, capital reserve, revaluation reserve, a specific reserve, dividend equalization reserve. What is difference between all these? See, first I will tell you, suppose the company has received the profit, matlab company has earned the profit from the operation, rupees 1 lakh rupees. Company has also earned the profit by selling fixed assets. How much? 2 lakh rupees. So see, the selling fixed asset is not the core business of the company. Fixed asset means that is the amount, that 2 lakh rupees the company has got from the selling of the fixed asset. Suppose the company was having land, uh, company had purchased land some 10 years back in anticipation that it will go for expansion of the project. But after 10 years, it realized that they have dropped the plan for expansion, and even the land is very far off, means it is not practically possible to use that land for business purpose. So the company has sold off that land, and company has earned 2 lakh rupees as a profit. So in that case, this 2 lakh rupees now it will be part of. So when you are preparing the balance sheet, so in the reserve and surplus, you will not write the general under the general revenue reserve. You will write under the capital reserve. Capital reserve मतलब कि the reserve has been created by generating the profit from the selling of investment. Okay. So the capital reserve you will write here 2 lakh rupees. So if you find friends 2 lakh rupees in the capital reserve, you should understand very well that company has earned this 2 lakh rupees not from the operation. Company has earned the profit from the by selling the investment assets. Okay. So now, so hopefully capital reserve is clear to you. Okay. Now coming to the revaluation reserve. Capital reserve is clear to all of you. Now coming to the revaluation reserve. Suppose the company is having fixed asset, same land of 100 lakh. Okay. And company is having, and this 100 lakh, how it was that land was purchased? Company has net worth, matlab capital of suppose net worth of suppose 20 lakhs and the term loan of 80 lakhs. So this is how the fixed asset was created. Now the fixed asset, it is totally the factory land and building. It is land and building. Now the company has got this fixed asset land and building revalued. And as per the valuation report, the value of this plant and machinery is not 100. The value of the plant and machinery is 150. So what company will do? They will not write now 150, not write 100. They will write here 150. Matlab in the next balance sheet after the valuation is done. Now they will write as 150. And on the left side, what they will do? They will simply write here revaluation reserve. They will write revaluation reserve. Okay. And they will write here 50 because asset and liability should match. Na? Here 150, then there also 150. So they will write 150 as a revaluation reserve. So now you friend, you see this revaluation reserve. So now the net worth of the company has increased from 20 to 70. So now you see friends, the company has not actually infused the business amount of 50 lakh rupees into the business. It is just a amount created dummy by the company because of the appreciation in the fixed asset, right? So because of this appreciation in the fixed asset, revaluation reserve has been created. So now whenever you are assessing any company now friends, so in that case, just to arrive at the ideal position, actual position of the company now, what you are supposed to do, you should, if you are receiving the same balance sheet where the fixed asset price is 150 and revaluation is 50, so whenever you are finding revaluation reserve as a 50, so immediately it should strike in your mind that the fixed asset price has been inflated, and the on the other side liability side that the 50,000 rupees 50 lakh rupees has been incorporated in the form of revaluation. So what you are supposed to do, don't write 150. What you do, you reduce from the revaluation reserve 50 lakh rupees, and accordingly from the asset side you also reduce 50 lakh and write 50 lakh. So tangible net worth it will be 20 and the term liability will be 80. So now actual position has come back if you are removing the revaluation reserve from the liability side and same amount from the fixed asset. So then you calculate the ratio. If you see from the first ratio 80 by 20 earlier, so the leverage ratio means D ratio was 4. And if you calculate even the revaluation reserve, then the figure will come 80 divided by 70. So it will be hardly 1.25 or something. So see from 4 it has come down to 1.25. So the company used to manipulate the leverage ratio, the D ratio by inflating the value of the fixed asset. Okay, so that's why friends fixed asset value should not be inflated, and or at the same time from the liability side revaluation reserve should not be there if you want to know the actual financial standing of the company. Okay, now company, so hopefully that the capital reserve and revaluation reserve you people have understood. Now coming to the revaluation revenue reserve and general reserve. The revenue reserve is the actual. Suppose the company has earned profit from the actual business, 10 lakh rupees. So here it will show in the revenue reserve. Revenue reserve 10 lakh rupees. Now friends, then what is general reserve? General reserve na generally the company, what is difference between the general reserve and a specific reserve? Suppose company wants to create a separate reserve. कि okay, for future expansion plan, for future contingency plan and all this. So the company have two choice. They can put create general reserve and they can create also a specific reserve. What is a specific difference between general reserve and a specific? General reserve, if you are out of 10 lakh rupees na, some portion amount they will shift towards the general reserve and some amount they will shift toward the specific reserve. If the amount is lying in a specific reserve na, it means the company has some future plan, and among from and the future plan how it will be financed from this specific reserve. So this specific reserve, whenever you are finding in the balance sheet as a part of net worth, it means the company is having some future plan and this reserve is being created for that purpose only. So I will show you one live balance sheet of a company where, friends, you see here reserve and surplus. The company, if you see from first, I will show you from here. See, friends, this is the profit and loss of a Amron battery. Okay, Amron battery means Amar Raja. That company is there. Okay, in the brand name is Amron battery. So if you see, friends, the company is having total profit of 2867. This is the profit 2867 in the year of 2013 and 367436 in the year 2000, 3674. This is in million figure. So the actual profit is 367 crore or 266 86 crore. So this is the profit. Now how it is, so 286.7. So out of this profit, how they are bifurcating from how they are how they are going to bring this amount into the balance sheet. So I will show you. Oh, sorry. First, I will show you, friends. You see here also this authorized capital, this 200, which we taught here, that this is the authorized capital, this is issued capital, this is subscribed capital. So subscribed and paid up capital. So whatever was subscribed, and this is the paid up capital. So this is the actual amount which will be reflecting in the balance sheet of the company. Now I will show you this profit and see what have told you. The company was having total profit of 2867. Okay, so out of 2,867 million of profit, what they have done, they are creating 286, means 10% of the profit he is shifting towards the general reserve. You see left side the general reserve is there. So 286 lakh 86 million rupees they are shifting towards the general reserve. So earlier the general reserve was 1530 and 286, means 10% of the profit again they have added back. So now the total general reserve it is lying 1817. Now 2867, if you bifurcate out of 2867, 10% they are putting towards the general reserve. 430 rupees 30 million the company is giving as a dividend, and this is the dividend tax. So whatever the amount is there now, it is now the closing balance of reserve and surplus, and this balance becomes the opening balance of the reserve and surplus. Opening balance of reserve and surplus. So now again in the next year the company has earned the profit of 3674. Out of that 10% that the profit has been put towards the general reserve. You see 10% and 551 they are declaring as a dividend, and this is declared test. So minus, so this is the figure. Now it will reflect in the reserve and surplus, and this is 367.44, this profit, whatever the profit out of this 10%, this figure they are taking towards the general reserve. So general reserve will keep on increasing, and because of the company is certain portion of the profit they are putting towards the general reserve. And what is this security premium? You see security premium account, security premium is share premium. 311, and this is the capital reserve means 0.01. From the capital reserve, the company cannot declare the dividend from the capital reserve. Company can declare the dividend from the profit of only operation from the reserve and surplus only. So this is how just I wanted to show you that how the company is showing their different type of dividend: general reserve, capital reserve, and reserve and surplus. Okay. So, hope that general reserve, revenue reserve, capital reserve, revaluation reserve, specific reserve, all these you must have understood by now. Now coming to the dividend equalization reserve. What is dividends equalization reserve, friends? This is nothing but the amount that from the profit. Na, this is reserve created to pay the dividend to the preference shareholder. As I said in the beginning, in the beginning means at the time of discussion on what is preference share, that in the preference share it is fixed that this much percentage of dividend that company will give to the dividend holder, preference shareholder. So, but suppose the company next year is going to incur loss. So in that case, how company will give the dividend to the preference shareholder? So in that case, what company will do, friends? So whenever the company has earned the profit, from that a certain portion they will put towards the dividend equalization reserve. And if the next year the company has loss, means it has incurred the loss, in that case company will debit from the dividend equalization reserve and pay to the preference shareholder. So the dividend equalization reserve is always created for the purpose of making payment to the preference shareholder. Okay, now coming to the share application finalized for allotment. See friends, nowadays everything is digital. Everything is digital. Matlab, now company is issuing IPO digitally, means you are also subscribing through the ASBA. ठीक है? ASBA means application supported by blocked amount. You are subscribing, and then paid up capital is being issued. But earlier in those days, some 10, 20 years back, it was not practically possible to apply through ASBA or online. We used to send the application to the company. Company will analyze the application form. If some information is wrong, in that case, they will reject my application also and send the amount back to the remit the amount back to me. Earlier, we used to make the payment in advance by issuing the check so that company will give me the shares. But so in this is now irrelevant in fact, but I will tell you, if you are finding any such type of share application amount, suppose rupees 20 lakhs, so it indicates that a company has received application for purchase of share from the shareholder for amount of 20 lakhs. So what is the present status? Whether this application company is going to reject or company is planning to issue. If the company is planning to issue shares against these applications, in that case, this amount will be part of the net worth. If the company is planning to reject these applications, in that case, it will be removed from the net worth. So depend upon the status of the application. So that's why I have written the word in bracket finalized for allotment. Finalized for allotment means the company can means company is now going to issue the share against that application. Okay, and preference share, as I said, some banks are more than 12 years they are treating as part of networks. It depends bank to bank, industry to industry, how you want to trade. If you want to suppose loan period is 10 years and preference shareholders value is for 12 years, means after 12 years only it is going to mature. In that case you can treat as a preference shareholder as a part of network. Now coming to the capital subsidy. What is cap? Suppose a company has purchased the plant and machinery of 100 lakh, and out of that 100 lakh rupees, 80 lakh rupees they have taken loan, and 20 lakh rupees that is equity that company has. Out of 80 lakh rupees also, the company is going to receive the subsidy of 20 lakh rupees. So the term loan outstanding will be 60 lakh. So whenever you are finding that the company has received subsidy of suppose 20 lakhs, should go deep into the subsidy details, because as I said, कि each component matters a lot, friends. Whether this subsidy is front end subsidy or back end subsidy. Front end subsidy means they will get in the beginning of the loan. Back end means they will go at the end of the tenure of the term loan. Okay, or a certain condition is there that after 3 years of the satisfactory running of the unit, you will get the subsidy. And front end means in the beginning itself you are getting the subsidy. So whenever you are finding that still some lock-in period is there in the subsidy, or this subsidy company can use after fulfilling the certain condition. This is not the free subsidy for the company to use. So in that case, this capital subsidy will be part of term liability. And if the company this subsidy is free from any liability, means there is no any rider or not any term and conditions on this capital subsidy. Means suppose I am giving you front end subsidy. Government of India has given front end subsidy of 20 lakh rupees to the company, but there is a rider that one clause is there that you can utilize this subsidy after a period of 3 years only if we find that your term loan account is running satisfactory, or if your unit is running satisfactorily for 3 years, or if you made the sale from this plant and machinery every year minimum 1 crore rupees. If such type of condition is there, so in that case this subsidy company is not going to use. So in that case what will happen, this subsidy you treat as a part of the term liability. But if you find that company has already fulfilled all the condition, now company can very well use, there is no rider, there is no default. So in that case this capital subsidy is nothing but the company's own money na? Though government of India has given, but this money nobody's liability lies on this subsidy. So this will be the part of the net worth for the company. Hope up to this you people have understood that what is the various component of the net worth. If still friends, I request all of you, if you still find any, if you have still any doubts related to this, then please raise your questions. I will try to respond. Okay, now coming to the last part of the component of the balance sheet is about the contingent liability. Contingent, I will tell you friends, and which are contingent liability which may occur or may not occur. Suppose you are studying a balance sheet of a company. First, I will tell you friends where the contingent liability is there. See, these liability na, there is no transaction. No transaction matlab transaction has not happened. No debit credit has happened with the company in all this. Guarantee issued, litigation, dispute, claim not acknowledged, warranty. Only in this case that we have already discussed in previous session. But if permits, I will discuss. Okay, so see, these are non-financials entry. So you will not get anywhere in the balance sheet. Then where you will get? You will get only in notes to account. Notes to account and auditor's report. Okay, because in the auditor's report or notes to account, auditor's notes to account is also called the footnote. Okay, so you will get these things in the footnote because there is no such transaction has happened with the company. So now the what is the, see, if the company is approaching you for a loan, or if you are planning to invest in a company, you find the net worth of the company is, net worth of the company is how much? 1 crore, 1 CR. And in the footnote, find that the company has issued guarantee to its subsidiary, ठीक है, in favor of SBI, ठीक है, in favor of SBI for rupees 2 crore. 2 crores. Now you friend, you see here how much important it is to understand about the contingent liability. So as an investor, as a banker, you must demand the balance sheet of that company. You must also study the account statement of that company, and and see whether there is a overdue, is a status is there or not. If the SBI demand or invoke the guarantee of your company, so in this case the net worth is only just 1 crore rupees, whereas SBI will demand 2 crore rupees. So from where it will give? Chances are there that this bank company will also become a bankrupt. So friends, whenever any such type of अब now litigation, I have seen, I will show you here also otherwise. Let me see if it is there. Hmm. Friend, you see here, in this case, the company, this same Amron Battery Amaraja case, in the auditor's report, they are saying that this much amount, how much amount? Around 10 crore. Means if you see, around 10 crore rupees amount, 100 million, around amount is under litigation. Under litigation मतलब these amounts the company that various authority means income tax departments, excise tax department, ठीक है, local this is old balance sheet, that's why that excise tax and other taxes are coming, but you see these are the authority means they have raised the amount from the company and company has moved to the court against this demand amount, and it is reflecting in the balance sheet of this company in under the auditor's report or notes to accounts. So from where you will find all these friends? So now you see 10 almost 10 crore rupees of disputed amount is there, which is shown by the auditors in the auditor's report. So friends, now the contingent liability, so litigation. So if the borrower is having suppose 1 CR of only the net worth and the litigation is 10 CR, so whether it is worth giving the loan or finance or investment in this company? No. Why it is not worth? Because the company will become bankrupt if the court case goes against this company. Okay, so that's why litigation, dispute, claim not acknowledged is the same that someone has claimed and if the company is not acknowledging. Warranty. Company has sold the goods of 100 crore and they are saying that I am giving a warranty of 2 years. Or now you see 2 years warranty the company is giving. So in that case, what will happen? If the all of a sudden all the products are in defunct, so in that case, how company will manage the 100 crore rupees? Because the net worth of the company is just 10 crore. So that's why these things now you should see and study. Then how you should take a decision. See, friends, I say investor or banker, how you should take the decision. If you are going to finance this company, so better I have seen many a times borrower is suppose there is a you in find 1 crore rupees litigation amount in a balance sheet of a company, find in the note to accounts. So I have seen that the financial institution are suggesting, please give me FDR of 1 crore rupees. FDR means infuse the capital. So company has infused the capital of 1 CR and FDR has been opened up once year, so that if the any litigation goes against the company, the financial institution will liquidate this FDR and pay the litigated amount to the court. Okay, but friends, now litigated amount to the court. But friends, see the just investing in FDR is not enough. What I say, due diligent banker or investor you should do, you should put this FDR of 1 crore in the form of lien in favor of bank only, because otherwise what will happen, company if having liquidity crunch, so what will happen, company will take this FDR to some XYZ bank or same bank and they will say that give me labor. Labor means give me loan against this fixed deposit. ठीक है, against this FDR give me. So now this FDR has been marked and company has taken the 80 lakh rupees. ठीक है, as a loan. So now you see if the now the company lose the case, in that case the FDR cannot be liquidated. Why? Because the FDR first the amount will go towards this 80 lakh rupees. Then only 20 lakh rupees only left over to submit to the adjudicating authority. So in this case, what then company will do, from the capital only they will pay to the adjudicating authority. So friends, this I will tell you, contingent liability are all non-financial transaction, but it has very much cascading effect on the balance sheet. It has compounding in fact means many a times the company becomes bankrupt because of this contingent liability, or the company defaults in loan, or the companies goes into liquidation because of this. Okay. So now coming to bill purchase under LC, already we have discussed in previous session, but again I will tell you, company suppose had taken CC 10 lakh, then a stock company has purchased 10 lakh. Now the company a stock has been converted into book dates. Book dates matlab 10 lakh, they have sold the stock and invoice, raised the invoice, booked it. Now company is approaching bank again and bank is saying, okay, I am ready to discount. Suppose bill discount, 10 lakh rupees, company has discounted. And the moment bank has discounted 10 lakh rupees, this bill, the company will receive the cash 10 lakh rupees, right? So from this cash, company will now pay this CC account, it will become zero, or straight away bank will discount from the bill discounting account and credit through the cash credit. So now bill discounting is outstanding and book dates is outstanding. So on due date, the bank will not demand from the company, bank will demand from the concerned debtors bank only. Okay. So now the liability of the bank is not lying with the company. So liability, since the liability of the book debt is not lying with the company, so the company will not show in the balance sheet, and company does not have right also over this book debts. So company will not show in the balance sheet. So where they will show? They will show in the footnote. What they will show? In the footnote they will show that I got rupees 10 lakh rupees of bill discounted from SBI. ठीक है, I got rupees 10 lakh rupees bill discounted from SBI. ठीक है, against the book dates of 10 lakh rupees, against the book dates of 10 lakh rupees. So if you find such type of term written in the footnotes, so in that case what you should do, you should see that with course, whether this discounting bill is with course or without recourse. What means with course and what means without recourse? With recourse matlab, if the debtors bank debtors banks refuse to make payment on the due date, then the bank who has discounted the bill has right to claim the amount from the company whose bill the bank has discounted. And without recourse matlab, if the debtors bank refuse to make the payment, then the bill discounting bank will not have any right to claim the amount from the borrower. So that is called the with recourse and without recourse. So whenever you are finding any such type of entry in the footnotes that a company has got the bill discounted for 10 lakh rupees or 100 lakh rupees or 2 crore from this bank, so, and against the book dates, so in that case you should find further whether it is with recourse or without recourse. If it is with recourse, then you treat this as a part of current assets and current liability. If it is without recourse, then you while assessing the proposal you can just mention only. So now I will tell you, with recourse is there, suppose how you should treat. If there is a with recourse, how you should treat? Suppose you find in the notes to account 10 lakh rupees book dates was discounted by the company and it is written in the footnotes. So whether it will impact the current ratio of the company if it is with recourse, so what you are supposed to do? Suppose the current asset of the company is 20 lakhs and current liability of the company is suppose 10 lakhs. So the company is having current ratio of 2. Now if you find that in the footnotes that company got his bill discounted for 10 lakh rupees and it is with recourse, matlab if the debtors bank does not pay, then the bill discounting bank is having right to claim the amount from the borrower. In this case what you will do, you should current assets, matlab what you do, current asset is earlier 20, now you add 10. 10 is what? This is the book dates. And now in the current liability, earlier it was 10, you also add this current liability means book date discounting amount of 10. So now you see 30 divided by 20. So now the current ratio has become 1.5. Earlier, if you ignore the bill discounting figure, the current ratio was 2. But if you add the bill discounting figure, then the current ratio is 1.5. Because of so friends, my request to all of you that the contingent liability is having a big role in to play when you are assessing the any financial statement of any company, and even the bill discounting under LC, how you should treat it. Okay. Moreover, friends, one more thing I will tell you. कि whatever suppose the company is having leverage ratio. Leverage ratio means total outside liability suppose 60 and net worth 10. Okay, the D ratio of the company is suppose 6. So you if any such litigation is there, na, in that case what you do, suppose the litigation is suppose 50 lakh rupees. So now you incorporate this 50 lakh rupees as a litigation also in calculating D ratio. Now you see 60 plus 50 divided by 10. So now the D ratio is 11. So whenever you are assessing the proposal or studying the balance sheet of the company, you also see that if we incorporate any contingent liability as a financial liability, so in that case, what will be the impact on the D ratio? So D ratio has jumped to 11 times. 11 means 5 times it has jumped. So now the D ratio is 11 instead of 6. So friends, these are the various components of the liability side of the balance sheet. Hope you must have understood by now to some extent. I know friends, it is very difficult to understand if you are very new to the balance sheet. But the good part, two, three things I would love here to mention is about the deferred tax liability that very few people understand, that I have incorporated in this today's session, that how the deferred tax liability is calculated. Anyway, if the time permits, I will prepare a separate video on deferred tax asset and deferred tax liability if people are very much concerned to know just only deferred tax asset and liability part. Okay, and friends, next week I am going to bring the session on various component of asset side. And in the meantime, friends, whoever join the class or whoever wants to see this video, I have put a link on the chat box from where you can attend the quiz. Quiz matlab you will know that where you stand, whether you are really able to classify into different bucket of the various liability of the balance sheet or not, and the score everything will come. So I request all of you, if you are watching my video, please attend the quiz also for better understanding. I am not going to give you any marks that you don't deserve, you deserve and all this, but I request friends, if you find if even 10% valuable to you for your knowledge, I request please spread this to among all your colleagues. My purpose is not nothing to increase the subscriber and all this. My purpose is whatever I have learned with my hard work, means with in a layman language, that the same I want to convey to all of you. Okay, so my request, please aspirate just to watch at least. Okay, thank you so much for watching my video and the live session. We will be in touch with all of you in the next session. Thank you so much.